Really what it is, if I put my money into this, let's say $100, $1,000, how long does it take me to get that $1,000 back? If it's a 30% margin, then it'll take me about 3 years to get it back. Hi, welcome to the Red to Black podcast. Here you will learn how to invest in highly profitable private businesses to create abundant financial freedom. If this topic interests you, we invite you to subscribe to our channel. This podcast is hosted by Werner Minchel, ex-Marine aviator and current real estate investor, and Mario Parzino, current Marine infantry officer and business investor. Which was enterprise value. Can you talk to us about that a little bit?
Absolutely. So enterprise value is a term. It talks about what it would cost you to buy the entire business. And you're thinking, well, all I have to do is buy all the shares and I own the entire business. Not exactly. You got to do that. If you want to own the entire business, you got to buy all the shares. You also have to buy all the preferred equity if that exists in the business. So that is preferred equity. You guys can look this up, but it is basically stock and a bond. It's stock that we pay out, or the business pays a return, a preferred equity return on that stock. So if to own this business, to own any business, what do we have to do? Got to buy all the stock in the company, and we got to pay off all the preferred equity, the preferred stock in the company. And then we got to pay off all the banks that we have debt with. They own a claim on the business. But in doing so, we also get all the cash that the business currently has in all the different accounts. So again, this equation, if we can write this out in our mind, write this on a piece of paper, what do we have to pay off? All the people that have a physical claim on the business. That's all the shareholders, preferred equity, etc. All the bankers that have a claim on the business. And then what do we get when we buy this business? Oh, we get the bank accounts. We get all the cash. So that is enterprise value. And you can go look up the accounting terms and read about that. But it is incredibly important when you're buying a business is to know all the people that have a claim on this business. And in fact, it's smart to hire an attorney, very savvy attorney that can tell you about, exactly what you're getting involved with. Attorneys protect you. That's what corporate attorneys, what they are there for in the business is protection. And they're going to do a deep dive and make sure you understand exactly who has a claim on this business, exactly the debt structure, exactly who has preferred equity, who are the preferred equity holders, how do we get a hold of these people and pay them off if they want to sell, So that's critically important. So enterprise value is, what does it cost us to buy the entire business? Over to you, Warner.
So one thing I'm interested in knowing for you, Mario, is what's the ratio or percentage for what's owed and what's actually valuable in the business in terms of like the cash, the plant, property, and equipment. So once you've paid everything off, then let's say, you pay off 2 million and you have 2 million left over, 50-50. What are you looking for? What's your metrics to determine a good enterprise value?
Okay, so actually the equation we want to use, Warner, is actually enterprise value divided by earnings before interest and tax, or operating income. So numerator, enterprise value, we just discussed that, divided by the denominator, earnings before interest and tax. That's what the business is generating. And even better is to take an average earnings before interest and taxes. So take the last 3 years, average that out. Take the last 5 years, average that out, and play around with that number and say, this is actually what I think the business on average does as an operating income. So we got enterprise value, our numerator, divided by earnings before interest and tax, and even better, an average earnings before interest and tax. And let's play around with that number and run that a few different ways. And when I get really excited is when I have a business that's north of 30% operating income. Our operating margin, 30% operating margin, correction. I get excited when there's a business for sale that has a 30% or greater operating margin, and it's trading or it's selling for 7.5x enterprise value divided by earnings before interest and tax, or operating income. Think about it this way. You're paying 7.5 years of operating income for that business, the enterprise value of that business. You're paying 7.5 years of the operating income to buy that business. If you walk down the street to a very marginal business, a laundromat, and you talk to the folks that own that, they will not sell you that laundromat for 7.5 years worth of operating income. They'll ask for 15 or 20. They're not going to sell you for 7.5 years. So you're buying, Oracle is a much better business than a laundromat. And occasionally, those kind of businesses, as crazy as this sounds, will sell for less than a laundromat. Over to you, Warner.
Yeah, so we're going back to, so it doesn't get too confusing for listeners. Maybe some listeners already are finance gurus and understand this, some aren't. For the ones that don't, this is their first time in it, or they're still getting used to it. We're looking at different marks. And mark number one is sort of return on invested capital, free cash flow margin, earnings before interest, debt and amortization, tax, debt, and amortization. And we're looking for around, say, 30%. Then what we talked about with enterprise value is when we get that ratio, then we're saying, like, let's go back to the example of the jet ski. I mean, that guy's getting paid back in half a month. You're being extremely generous, saying it'll take me 7.5 years to get paid back on all my assets. So, but the difference is that's a massive company, Oracle. This is a small operation. It's just a way to look at it. For example, if I put my money into this, really what it is, if I put my money into this, let's say $100, $1,000, how long does it take me to get that $1,000 back? If it's a 30% margin, then it'll take me about 3 years to get it back, right? So I put before taxes, it's very general, before taxes and all the other expenses. But if I put in $1,000, I get 300 back, right, each year. It'll take just a little over 3 years to make my money back. That's where we're kind of going with this on a very, very simple basis. So if you want to look at any business, the simple question to ask yourself is, if I put money into this business, how much am I going to get paid out? Not appreciation. Appreciation, like Mara and I look at as the cherry on the top. How much am I going to get paid back? Because here's what people miss. They're looking for appreciation. We talked about this in the last podcast, but what they forget to talk about or forget to understand is that I want to know, if I lend my money to you, that I'm getting something in return for it. And I don't want appreciation in return for it. I want cash flow, because cash flow will always, if it's a consistent business, will pay me consistently. Appreciation is based on behavioral economics, and who the heck knows what that's doing. I mean, we've had stock markets, like Warren Buffett said, if you look at different years, sometimes they've gone up 5x, but sometimes they've stayed level or gone down for 20 years. So if you're in that situation where the business doesn't appreciate it at all, but yet you're getting paid 30%, you are doing well. What are your thoughts on that?
Absolutely, Warner. Those are perfectly acceptable criteria to deploy capital. Is when you can find a business that's generating a 30% operating margin and you're getting it for a great deal. Sometimes there's occasionally a time in the public markets, not often in the public markets, but there's occasionally a time where you can pick up these kind of deals where these are extremely profitable businesses and they're selling way less than what they should be, because they're selling at valuations which you couldn't even pick up a very marginal business that's privately owned. Then there's other times where the stock market is very properly priced or even overvalued, but private businesses, people, it's messy. Private businesses are difficult. There's people, and these things are selling way cheaper than a public market. There's no right answer all the time, but you constantly need to be looking, or you should constantly look for deals. That might be in the public space, that might be in the private space. Warner and the Purple Merchant even look at real estate all the time. They're constantly looking at deals in the real estate market, because sometimes it's mispriced. Even in real estate, there's occasionally an asset that's mispriced, and there's opportunities there too. So by hunting in these different markets, you're occasionally going to stumble across the $100 bill. And a great investment is simply reaching down, identifying that is actually a $100 bill, picking it up and put it in your pocket. Back to you, Warner.
Yeah, and what's the difference between private businesses, what Marty and I like so much, and it's what my dad told me, is he's been a real estate investor for 40 or 50 years. And what he told me is people constantly get tired of their real estate. Like Lydia and I got tired of our fourplex. And they're like, no, it's a great asset. It's paying us a great return, 30, 40% margins. But even with such great returns, we're going, it's such a small asset, it's taking up time. We could take this cash flow out and put it somewhere else. And all these metrics that Mari and I are talking about, the reason why we have these metrics, because if you don't have a metric upon which to determine where you're going to invest, you're following a pipe dream. You're in the gambling market. Now you're doing behavioral economics and probabilities. What Mari and I are talking about is understand your metrics, and it's a simple metric at the end of the day. If you forget all of these, if I give you $100, how much am I going to get in return? That's all you need to know. Now, the reason when you go deeper when you're buying a business, because you want to know that 30, let's say 30% return, that $100 is going to be consistent. So if I had to name two things in your investing strategy, what do I get in return for giving you this money? And then number two, will that remain consistent over 10 to 20 years through the ups and downs of economic turmoil? Those are the two main things. If I had to break it down to just nuts and bolts for anyone, what do I get in return? And will that consistently come back to me? Thank you for listening to the Red to Black podcast. We really appreciate you taking time out of your day to listen to our podcast. If you would like to connect with us in the future, you can find us on LinkedIn. Simply search for Werner Minchel or Mario Parzino. Also, you can find a link to our LinkedIn profiles in the profile section of the podcast. Thank you again for listening, and we look forward to connecting with you in the future.